Hey everybody, this is Jason Matthews, President and CEO of Gibson Monroe Wealth Advisors and Matthews Financial Insurance Solutions. Right now, it's the summertime. We want to do a little session during lunchtime as you guys have a brown bag lunch at the office or at home and just educate you guys on a lot of information. So, all of our clients, this is a topic we're hearing a lot of people are warning about and curious about. So, today we're going to talk about RMDs. And which is a huge topic for a lot of retirees when they're thinking about retirement and the concern that a lot of them do have. And if you don't know what RMDs are today, we're going to go insight about RMDs are, how they work, what's the penalties if you don't do it, and strategies how you get around it. So to just really better educate you. As I always say, we're here to educate the American people so they can make better decisions for themselves, their family, their community, and their business. And if you really get something out of this, please like it, please share it, as we're definitely going to keep pushing out more and more content to educate the American people. As I said in my book, if you never got it, please put in the chat. We'd love to send you guys the email of our free e-copy of it. In my book, The Age of Self-Reliance, this is the period of time where the entities that give us these promises to keep are going to be unable to keep those promises. I said that in 2018, and it seemed like it was ahead of a time as we're seeing more and more struggles right now in our cities and local governments. We hear in Oakland where our office is at, we hear about this huge deficit. There's also in San Francisco, New York, Chicago, and a lot of major cities are happening, and that is going to affect people who might even been working at those cities for 20 or 30 years, and it's going to affect them coming up soon. So let's dive into what is RMDs. And what RMDs stand for is required minimum distributions. This is something, if you have been a great saver, that you're going to have to eventually face in time. And here's the reason why. And let me explain this to you. Happen. There's three buckets of money. There is the tax me now bucket, right? Which is I put the money in. The money I'm going to have to pay taxes on that money. Eventually when they're in the tax me now bucket. Or let me break this down even easier. There is a tax deduction bucket. I got the money is tax deferred, which means I didn't pay taxes from the very beginning. The money been growing without me paying any taxes on that money. And then eventually when I pull out that money, I'm going to have to pay taxes on that money. The second bucket is our tax-free bucket. The money is taxable from the very beginning. The money grows without me paying taxes on it. But when I pull out the money, it's going to be all taxable. And then the last bucket, it's all going to be all tax-free. And then the last bucket is our taxable bucket, where we're going to have to pay taxes as we buy and sell things, receive interest or dividends. This is like our brokerage account, our savings account, and so on and so forth. The bucket that we are talking about right now is this middle bucket, which is the blue bucket, which is the tax me later bucket. And what the IRS is saying, hey, you might have started this when you're 18 years old with your first job, and you've been having this money grow, and then you hit a certain age, and guess what? We are tired of seeing this money just grow and accumulate over and over and over, and we have not seen you pay any taxes on that money. So what we're going to do now is it's time for us to collect. They're ready for it. And right now with the deficit and everything else, they're going to be ready for it more than ever. So what happens is if you are at the ages of 72, 73 or 75, depending on the year you were born, you are required to take a certain percentage out of your tax deferred bucket because the IRS wants you to pay taxes on those funds. They're getting tired of it, right? But it's not always just our retirement accounts. There's some other accounts that can be included as well. And the other account that can be included with this is our IRA beneficiaries accounts. What is an IRA beneficiaries? IRA beneficiaries is if we inherited an IRA. This could be oftentimes we might receive an inheritance because we're a spouse and our widow passed away. We could receive an IRA because we're children of it, or it could be any other group, such as a charity, an estate, or a trust. And because of that, depends on what situation you are, you're going to also have to pay RMDs. For instance, who is eligible or not eligible and have a 10-year where they have to take out RMDs is non-spouses and certain trusts. So if I receive it and my mother, if God forbid my mother passes away, I'm going to have to pay RMD with the 10-year rule. Now, give you guys a heads up in this situation, we have seen the IRS over the last few years have kicked back and pause or not do that. But what they do require is by the end of the 10th year, you're going to have to pull out all the money if you inherited that RMD. So you might not pay it right now or pay it over 10-year periods, but you're going to eventually have to pay all that money out. And usually what's supposed to happen, but unfortunately has not, is that or I want to say unfortunately, just has not been a requirement, is that you're supposed to take that money out over a 10-year period, which is very understandable about what's going on, right? So how do we calculate RMD, right? The way that we calculate how much money is RMDs or you got to take out of your retirement account is by doing a couple of things. And there's a couple of formulas they have. And the formulas that they have is either a uniform lifetime table, a joint life expectancy table, or a single life expectancy table. So pretty much, let me break this down in the simpler context and terms. At the end of December 31st of the previous year, whatever that account value is, there is a formula based off that value of that account that you're going to take out some money out of that account. And based off that formula, you're going to have to take RMDs off of that amount. Now, there's three tables. They have the uniform lifetime table, the joint life expectancy table, and the single life expectancy table. Now, based off you and your situation and how you are affected by RMD, you're going to have to use one of these tables. Now, what I recommend, and I highly recommend, is when we're doing this situation, is that you should not be doing it yourself. This is where you should bring in your financial advisor, such as myself, or your CPA to really help you figure out and calculate what that number is. Because if we don't do that, there's some things that we might have to face that we really do not really want to face when we're calculating it. And what is that we have to face? Taxes, right? And penalties. So first, with RMDs, we're going to have to pay taxes on RMDs on that amount. So let's say we have $1 million. They make us take out 30-some thousand. Where that is now taxable income, we're going to have to pay taxes on it. Now, if we don't, let me say this, we fail to do it, we're going to have to pay taxes plus penalty. What is that penalty? 25% of the account value. Wow. So you have $1 million, 25%, 250,000. Cheaper than, let's say, 37,000, right? So that's a huge penalty. And if you do come across this is where you should contact your tax advisor, your financial advisor to help you, because there might be some strategies on what you could do and how to communicate with the IRS to help you avoid those penalties. And if the IRS is charging here in California, and I know most other states, they might try to charge you as well for having to not taking that money out. So get ready for that 25% penalty, right? So, but you know what? There are some strategies that we should be doing. And there's some strategies that we could do to minimize our RMDs, right? So I'll always say this, the strategies we have is you want to game plan beforehand. These strategies should not be at the last minute. Oh, taxes, I need to hear and do this at the last day before it's too late. You should be making these calculations and doing this part of your whole retirement plan years in advance, knowing that eventually you are going to face RMDs if you're lucky enough to live that long, and if we are blessed to live that long. So here's a couple of strategies we should be using and actually doing. So one is putting together a tax-efficient withdrawal plan. I think this is a very, very important. Is there ways that we can do withdrawals and avoid and make it efficiently to do it to reduce our RMDs? Second is charitable giving, right? Oftentimes I have a lot of clients who might give back to come out of pocket to pay to give back to the church, to some nonprofit or some causes they really believe about. One way to get around RMDs is by giving a certain amount of your funds as a charitable gift out of that account. So instead of coming out of pocket and paying for those gifts throughout the year, sometimes you might just write a check out. Do a charitable giving outside of with your IRA account. Another one is Roth IRA conversions. Now, this is great. If you convert some of your money over to an IRA, over to a Roth IRA, which, all right, let me break this down, is if you take money that was in your tax deferred bucket and now put in your tax free bucket, once you put in that tax free bucket, there are no RMDs. That money grows tax free forever, which is huge, which is powerful, and can be a great benefit. So when we do that, you should be looking at when is the best time for you to do Roth IRA conversions. Usually, we look at doing Roth IRAs conversions when we have money in the savings to cover paying the taxes on those funds. Also, it's a low income year for ourselves as well. Another strategy is reinvesting in our RMDs. So once we take that money out, if we don't need that income, reinvest that money somewhere else. Is it giving back? Is it building up a college fund? Is it putting money in your brokerage account? But you should be reinvesting those funds. And here's the last one that's not on here, but we have definitely having a conversation with a few of our clients about. A lot of our clients might be in that age where they're supposed to have RMDs, but guess what? Or they're about to hit that RMDs, but they're still working. And a strategy that we're looking at that a lot of our clients are doing that you won't hear from a lot of advisors because there's no benefits from a lot of advisors is putting that money inside of their 401k plan. So if you're working, if you're retired, and guess what? You do not need those funds, right? And let's say, and you don't need those funds, right? I mean, you're still working. What you could do is take that money from IRA account and put it into your employer retirement plan. Now, employer retirement plans do not have RMDs. So that money, if you're still working there at your employer plan, you have that account, you're not paying any taxes on, no RMDs on that money. That money's still growing, that money's still compounding. So if you're working and you have a 401k plan or employer retirement, put that money there. And at that point, you're avoiding RMDs until you actually put the money in your IRA. Great tax tip for a lot of us, right? So let's go back to the next thing. Right. So the next thing that we want to talk about when we're looking at RMDs, and that's about it with RMDs. So if you guys have any questions, here's what I want to tell you guys. When it comes to RMDs, you should not be doing it alone. Not at all. This is very complex, especially in your first year. This is a very complex thing. And the penalties of it is very, very, very expensive. So what I highly recommend in this situation is make sure you contact somebody, your financial advisor, your CPA, and make sure you have a plan. You do not want to do this alone. As I said, that is a 25% penalty on the value of that account. And that can be very detrimental for a lot of us entering retirement. Now, if you guys have any other questions, make sure you just reach out, put it in the chat. I hope this was helpful for many of you guys. Talk to you later.